Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're just going to do another velocity banking review. And not only are we going to review velocity banking, but we're also going to use this as an opportunity to celebrate that we've officially reached 4,000 subs. 4,000. You see that right here? 4,000. We're going to go ahead and dramatically zoom up. Let's go ahead and do that. Whoa! Take a look at right here, 4,000 subs, right? 4,000 subs. And the next thing you'll know, we'll reach 9,000 subs. And if you know anything about Dragon Ball, that's a magic number. Okay. Once you reach 9,000, then your power level is unimaginable. Okay. We're going to reach 9,000 soon. So, what are we going to do in this video? We're going to review something called velocity banking. So, what is velocity banking? All it is a debt payoff strategy where you throw all of your money into something called a line of into debt with the help of a line of credit, right? And believe it or not, I learned this strategy when I was making like $20,000 a year. And I remember back when I first learned, I was like, why am I even learning this strategy? I was like, like I'm never going to be able to use it because you need something called a line of credit, and I don't qualify for that. And you know why I know I didn't qualify for it? Because banks don't lend money to people who need it. And but here's the thing, fast forward a couple years later or many years later, I eventually got a $280,000 line of credit. But here's my point, okay? Now, I know some of you are looking at this and you see this $11,000 a month income and you're thinking, well, that's not realistic, right? Like, but here's the thing. I still learned this when I was making $20,000 a year. And what's my whole point of this? Um, even if you're at a point where you're not where you want to be, if you just have the mentality, right? 95% of success is mental. Okay. If you just have the mentality that you're gonna get there and you should practice these scenarios, you will, it's like 99.999% chance, kinda like those germ, like sanitizer commercials, like 99.999% chance of getting rid of all the bacteria. It's a 99.999% chance of becoming successful, right? And the way that I think about this is you ever hear about the first class story from Donald Trump? I'm going to go ahead and play this because I think it applies to all of you who think this is unrealistic. And if you think it's unrealistic, then it'll be true. And if you think you're gonna get there, almost 99.999% sure you're gonna get there. So let's go ahead and play this.
Well, I have a friend who was not successful at all, but was really up and coming. And he had a thing. He would only fly first class. I'm not saying do this because for somebody it won't work, but he needed that mentally.
Right.
He wanted to fly first class because mentally he wanted to think he was the best, and that's it. And even though he didn't have much money at the time, this is years ago, he would always fly. I used to criticize him, but it put him in a good state of mind, and he
Yes.
became a very, very successful guy.
Yes.
Very, very
Yes.
successful. And I've always remembered that. He would never fly coach. He would always fly first class, even though he didn't have the means to fly. So, look, it's complicated, but whatever it takes to train
Right.
that.
Yeah, it's true, right? So even if you're not here yet, remember, practice anyways because this is you flying first class, okay? So I like I said before, I used to make $20,000 a year and I learned this and I was like, why am I learning this crap? And then next thing you know, paid off my mortgage in 2 years and 9 months, okay? And right, like you take a look at this 2 years and 9 months. And then I have a $280,000 home equity line of credit. So let's get back to the basics, but I wanted to put a little motivational story there before you're like, well, this is so unrealistic. Folks, me creating a channel called Korean Atlanta Mentorship and thinking it's going to be a success is very delusional. Okay, it's very delusional, but it's all about the mindset. And so I keep creating videos and I know it's going to be a success and we're at 4,000 subs right now. All right. So let's go ahead and get started again. So what do we need for to do velocity banking? Number one is we need a budget. Okay. So we have $11,000 a month income after taxes. And then our expenses is $11,413.22. And so we're in negative savings territory. Okay, negative savings territory. And if we do an expense breakdown, We list every single debt that we have because our whole goal is to get rid of all the debt. And then at the very last line, we just kind of combine our general non debt payments like food, gas, insurance, things you have to always pay for when your debt goes away. Okay. Now, here's the thing that was really painful to me when I first learned velocity banking because I wasn't making more money. There was a business credit instructor, and she would always be like, "Banks don't lend money to people who need it." And I was like, "I don't know what you're talking like, why am I here? I need the money." And then one of the things I realized is that it's this is a cash flow management strategy, right? Because there are a lot of people out there who make good money. Okay, well, there's enough people for who okay, who make good money but the bank can offer them debt so that they don't pay it off too quickly, right? Because once upon a time, and let me just kind of do this right here. People who make good money did not have any debt, right? Like, oh, $8,300 of savings. But the banks, because and the credit bureaus, because they share information, they're going to give you mailers saying, hey, why don't you take on some credit cards? Or hey, why don't you take on an auto loan, right? Or hey, you should get a mortgage. And if you didn't know, in this country, 90% of people can't even get a mortgage, right? So the bank is targeting people who make money, but kind of suck at managing it, right? And then what they hope, kind of like a nice vampire, is to suck your blood with payments, AKA interest, okay? And that's how we ended up with this good income and then it got sucked out of us with all these debt payments. So that's how banking works, and with velocity banking, what we're doing is just trying to get rid of these debt payments and making it easy on us without having to make more income, right? So let's go ahead and copy these expense payments, and then here this is $0, okay? This is $0 savings. And what we're going to do is increase something called cash flow. So here's the secret sauce to velocity banking is that number one, you're not going to save any money intentionally, right? That's what this is for, to say you're not going to save any money intentionally. And so if you take a look at my checking account, anytime you see it, if it's not 0, I'm a little bit worried, like, why isn't it 0, right? Because anytime money comes in, it'll hit the checking account and it'll leave the checking account as soon as possible, right? Because in our examples, it's going to our line of credit. So money comes in, checking account, and as soon as it hits the checking account, it goes to the line of credit. When we need to pay our expenses, it comes out of our line of credit, hits the checking account, and then we pay our expenses, right? So the difference between the average American and the velocity banker is that the velocity banker uses their line of credit as their main operating account, whereas the average American uses their checking account as their main operating account and uses their checking account to pay for things and then put the leftover in savings, right? With velocity banking, we ain't having any savings. That's what this is saying. Like, what savings, right? And what we're going to do is try to increase something called our cash flow, which is the amount that our debt gets reduced or destroyed, right? So in this example, we're going to assume we have a $150,000 line of credit. Like I have a $280,000. And like I said before, you have to do this the right way. You have to get the line of credit before you ever need it, right? And that's just true how banking works. Banks don't lend money to people who need it. And so if you try to get a line of credit when you're negative $413, they ain't going to lend it to you. But if you know this strategy before you ever take on debt, you'll never even get here. 99.999% chance. Okay. So let's go ahead and do this and sum up these credit cards. So this is going to be 25, 26, 50. And I'm going to go ahead and sum it up. And then now this is 101, 000, $101,000. And guess what happens by simply doing a debt transfer? Okay. Oh my goodness, 000. And this literally went from negative $413.22. And let's go ahead and zoom up to 3,000, almost $3,000 cash flow. Whoa, how did that happen, right? We literally went from negative to positive without making more money. How is that And we did not save it. We did not save it. So whether we have positive savings or negative savings, this is simply going to go to 0. And remember, you are going to make that money. But when you make that money, that's when the debt offers come in, and that's how people get screwed. Okay. You don't get really that much debt offers when you're poor, maybe a $500 credit card. But the more money you make, the more they want to make you debt offers, right? More credit cards, more loans, more mortgages, just take it all. And then next thing you know, the bank will have the tallest buildings in America, which they already do, right? And remember, you are already in first class, okay? All right. So let's go ahead and do the actual calculations. So let's go ahead here. So in order to calculate the next month's balance, it's based on the previous month's balance plus the previous month's interest minus whatever our cash flow number is, which is 2975.12. And then what we're going to do is take the average, right? The average daily balance, multiply by the interest rate, and then you divide by 12, right? So we're going to do that right here. I'm going to copy and paste, right? Whoa, take a look at that. Paycheck in, expenses out. Whoopsie, skipped a few lines. And whoa, I went all the way to, I got to go up. All right. So I'm going to do this, copy and paste. And then you'll see right here, copy and paste. And then we see that in 39 months, ooh, that credit card debt's gone. So just a little bit after 3 years. Hold on. Yeah, a little bit after 3 years, that credit card debt is gone, right? So that's 101K to to pay off 39K, or I'm sorry, 39 months of credit card debt, 101K. See how easy that was? That was easy, right? All right. So now let's just go here. Where do we go? So now luckily we have a loan calculator. Okay. So with our loan calculator, we just got to put the current month here, 39, 39, 39, 39. And that just tells us the current balances of our loans. And the easiest way to figure out which loans we pay off is something called the cash flow index. And so what is the cash flow index? It's just a simple formula of the balance divided by the payment. And why do we use this? Well, you use this as a ranking system to figure out which loans to pay off, or debts to pay off in general. And the lower the number, the more bang you get for your buck. Okay. So for example, do I want to pay 418,000 to get only $1,800 of cash flow in my life? Or pay 149,000 to get $2,322.17 of cash flow, right? Makes sense. So we're going to go ahead and pay off the lowest ones first, get the most bang for a buck in just terms of cash flow. And we're not only looking at the interest rate, even though the interest rate does have an influence on that number. So let's go ahead and do this. And then 22 grand. Okay, 22 grand is the amount that we pay into the line of credit. So let's go ahead and do that right here. So plus 22517.81. And then once we've done that, okay, now this is going to be 00. And we now have an extra $1,000 in our cash flow, extra $1,000. So let's go ahead and do this. And I am going to, okay, do this, Control V, update our cash flow, which is 4080.61. All right. So it only took us 1, 2, 3, 4, 5, 6 months to pay off 2 car loans. Sweet. All right. Let's do this right here. So 101 plus 21 plus 40, 162K. And then this is going to be 39 months. 39. Wait, what what month are we at? We're at month 45. All right. So 45 months. All right. So let's go ahead and do this right here. So 45 months. 45 months. Okay. So we got that. And now we got only 2 loans left, which is the student loan and the mortgage. So student loan right here in month 45, 45, and then 00, and then right here. So we have $140,000 in our student loan, right? So one of the things that we have to understand about amortized loans and the cash flow index is that if the cash flow index is really, really high, like this number, like 217, and we have a huge interest rate difference, it is going to affect how much interest we pay. And we normally don't want to move anything that has a huge cash flow index and a lower interest rate, like a lot of mortgages had in the early 2020s, into a line of credit. Right. But this one here has a 7% interest rate and we'll get $2,000 of cash flow. So we should be good. So I'm gonna go ahead and move this into a line of credit. I'm gonna do this right here. So paste. This is gonna be plus 140,735.53. Okay, so I did do that. And then now we get an extra $2,000 of cash flow back into our life. All right, so we're going to do this. And then, so now it's 6402.78. Okay. And then I am going to copy and paste this. And so we see that in 69 months, right? 69 months, it's been all paid off, right? So 69 months. And then this is going to be 362K. And now, time for the mortgage. So it's gonna be 0, it's gonna be 69. And then so now we just gotta do that. So 450,391. Now, here's the thing. I know a lot of people might say, well, it's only a 3% mortgage. Why should we pay it off? Because 3% after 30 years means you're going to pay 50% interest. So if I do 360 right here, you'll see that you'll pay $232,000 of interest. So what we're trying to do is pay that sucker off quickly and get that cash flow back into our life. But the most important thing we have to understand about the 30-year mortgage is you have to pay it off last, right? Because of that cash flow index, okay? So let's go ahead and open up the Velocity Banking Calculator. Give me one moment. All right, so let's go ahead and do this, which is the original balance right here. So it's a 450,000. What is the current balance? It is 391,924.24. So 391,924.24, 30 years, and this is 1897.22, 1897.22. And then what is the monthly income? It is, what's her monthly income? $11,000. And what's our living expenses? It's 2,700. So it's everything except for the loan we're trying to pay off. Now, here's the most important thing that I'm going to talk about is that you'll see on the internet that people advocate, oh, replace your mortgage with the 8% line of credit. Doesn't matter what the interest rate is. And then you could see it does get paid off quickly, 4.8 years, but you pay 81 grand of interest. Whereas if you just kind of pay it in what we call small chunks or chunking, $11,000, look at that. 27 grand, 4.3 years, 27 grand. So even if you use a 30% credit card, which is 35 grand, that's going to beat an 8% replacement of the mortgage, right? So interest rate does matter, but not really. All right, so let's go ahead and go back. It's 4.3 years. We're going to do this. So 362 plus 450, which is 812K. And then this is going to be 69 plus, what was it? 4.3 divided by 12. 4.3 divided by, no, it's 69 divided by 12 plus 4.3, which is 10.05 years. Okay, so 10.05 years. And again, it's not just the mortgage, it's all of your debt, right? To pay it off. Not bad. Paying almost a, not close to $1 million, right? Just but near the $1 million range. And now we're debt free and we have $8,000 of cash flow in our life. And now that's when we're going to have to save money because we have nowhere else to put it because we paid off all our debt, right? So $8,300 of cash flow. Wow. That's amazing. Okay. And here's the other thing too, 4.3 years, 4.3 years. Now, if I take a look at this, I'd be disappointed if I paid off my mortgage in 4.3 years. And you might be shocked to hear that. And why is that? It's because I've already paid mine off in 2 years and 9 months. If you take a look at this, just stare at it, maybe and pause it. 2 years and 9 months, I paid it off. Bought my home in around November 2021, and then you'll take a look here, July 29, 2024, paid it off. And that's how I got a first lien home equity line of credit of $280,000. All right. Well, that's it for today, folks. So just another velocity banking review. And again, if you think this is unrealistic, remember the story of being a flying first class. Now, I'm not saying you should do it in real life, but at least with these velocity banking spreadsheets, you could probably have that mindset in a much easier way by pretending to do $11,000 a month. Well, not pretending. Well, by doing $11,000 a month simulations of velocity banking, right? If you think that's unrealistic, hey, I was learning this when I was making 20 grand a year, right? Like, how delusional was I? I was thinking, well, I'm one day I'm going to apply this, and next thing you know, yeah, I guess I did apply it. All right, well, that's it for today, folks. 4,000 subs. I'm excited about going to 9,000. And you'll be like, well, 9,000, why is that a special number? Because, I will eventually say it was over 9,000. So it's a meme from Dragon Ball. Over 9,000. Okay. Can't wait to get there. All right. Well, that's it for today, folks. Have a great day, and I'll see you on the next video.